Namaste to all. Good afternoon to everyone and to the esteemed panelists we have today. We have CS Narayan Shankar and CS Pramod Rai. And I also extend a warm welcome to all of you listening in to this webinar today. This is the last day of the 3-day programs we had, series of events on secretarial standards and guidance notes. I'm sure you've all enjoyed and benefited from the day 1 and 2. Today, the topic is dividend and post report, significance of SS-3 and SS-4. John Maxwell said, a leader is one who knows the way, who goes the way and shows the way. I would like to emphasize on showing the way. It's not enough if you just know something and do it. It's equally important to share those ideas, those thoughts, and bring in the sense of advocacy. And this is what I think we did this time after the reconstitution of the expert group on secretarial standards. The number one agenda all of us thought we must have is to advocate secretarial standards and guidance note as much as possible. And so you all saw the Secretarial Standards Week being celebrated in April, and now this is being followed by this 3-day event. We already covered SS1 and 2, and we had a very thought-provoking deliberation on Saturday on related party transactions. And personally, I look forward to very interesting deliberations by both the gentlemen here who are fellow members on the expert group on secretarial standards. I have the pleasure of introducing the first speaker for today, that is CS Pramod Kumar Rai. He's a fellow member of the Institute and a law graduate from Delhi University with over 26 years of experience. He's currently the Associate General Counsel and Market Compliance Officer of Nestlé India, which is a leading public listed FMCG company with a market capitalization of over 1.7 lakh crore. He heads various functions such as corporate legal, secretarial, governance, compliance, and investor relation functions. Pramod is associated with Nestlé for the last 18 years, and his association is only going to get stronger because join me in congratulating him as he is slated to take over as the company secretary and compliance officer of Nestlé India with effect from 1st October 2022. Pramod, wish you all the very best from my side and on behalf of everyone who is tuned into this webinar for this next part of your journey. Before Nestlé, Pramod has worked in packaging and automotive industry for over 8 years, leading again legal, secretarial, insurance, audit, and investor relation functions. Apart from being a thorough professional, he has also been contributing back to our community and to the industry at large by being a speaker at several programs which are being held by ICSI, NIRC of ICSI, ASSOCHAM, and FICCI, including NISM. He's been a standards board since 2016 and now as member of the expert group on secretarial standards since 2021. He's representing FICCI. He's also a member of the quality review board of ICSI since 2020. On a personal note, whatever little I have observed about Pramod, we haven't met though we are in the group. It's all been only virtual interaction. But I see when there is chaos, when there is a din, when there are people trying to make their points vociferously, there will be a one lone voice, from this dapper gentleman who will be raising his finger and saying, Chairman, sir, can I ask a question or can I make a point? That's how polite and professional he is in the way he presents himself as a member and make sure that his points come across. Then I know that there is some sanity and calmness. He brings in a new perspective or he makes his point, and that's what I have observed about you, Pramod. And I'm sure you're going to bring in all that knowledge and that maturity in your talk today. I welcome you to deliberate on the topic of SS-3, dividend, and significance of SS-3 on dividend. Over to you, Pramod.
Thank you, Sharda Madam. Thank you for the nice introduction. Good afternoon, all the participants and the fellows panelists. It is my privilege to be invited to speak on this very important topic. You can imagine that secretarial standard is named as secretarial standard number 3. There is a reason for that, because whenever there is a deliberation on a secretarial standard, it is dividend and board's report comes always as part of the important agenda, and that's how the priority it is. Just to make a disclaimer, the contents of this presentation are intended to provide general views on the subject, and it is my personal views and should not be taken as an organizational position or nor views of the expert group on secretarial standards. So the topic given to me is Secretarial Standard 3. So what I will try to do is, first time I have even did this analysis where I have picked up Secretarial Standard and all the relevant sections and then compared with the Companies Act or SEBI listing regulations. So what I will do, I will make Secretarial Standard 3 as base, and I will also then share the other correlated provisions under law. When you talk about dividend is always thought as a return on investment. In a general parlance, it means whatever investment has been made on the share capital, the return on that capital is called dividend. It is distinct from borrowed capital, which is in the form of interest that one earns over the amount that has been parted with. In commercial usage, as all of us know, the term dividend refers to a share of profits of a company that is distributed amongst its members. Definition under Companies Act, if you see section 235 of the Companies Act, there is the definition says only dividend includes interim dividend. So this in this Secretarial Standard 3 webinar, what we will be doing is we will be covering both final dividend as well as interim dividend. Capitalization of profits is not a dividend. That has been made ample clear in the Companies Act as well. However, for the sake of sanity, bonus shares which are issued by the company are not something, the assets which are distributed to the shareholders, and therefore it is not covered. Similarly, Section 8 of the Companies Act prohibit under their own charter to pay any sort of dividend. Just on the scope, the Secretarial Standard prescribes a set of principles in relation to the declaration and payment of dividend. It covers subjects not just which are part of the provisions under Companies Act or the SEBI LODR. Also, it covers various rules. It covers certain governance practices which are good to go. Although it only talks about equity shares, but it also covers for exhaustive list of what preference share capital has to be dealt with as far as dividend is concerned. This standards is in conformity with all provisions of applicable laws, and any changes in the subsequent law will obviously be prevailing over this. This does not apply to company limited by guarantee, nor having share capital and dividend declared on liquidation. The provisions of Secretarial Standard 3 are recommendatory in nature, and this is recommended to be adopted by every company who's dividend paying. Now, when we go to dividend, again, the definition of dividend is not given. However, in Secretarial Standard, it is defined as dividend means distribution of any sums to members out of profits and wherever permitted out of free reserves available for the purpose. Also, in the Secretarial Standards, final dividend has been defined, which means dividend which is recommended by the Board of Directors and declared by the members at the annual general meeting. Interim dividend, as it suggests, means dividend which is declared by the Board of Directors during the financial year, anytime. There are also two terms which are often referred to is special dividend and deemed dividend. Special dividend is something which is not specified either in the law or under Secretarial Standards. However, for the sake of professional sharing of knowledge, in case there is some windfall gain, in case there is some spin-off, so in case there is an amalgamation, there are special circumstances under which the profits or the accumulated profits of the companies are distributed, which is not part of, for example, company's usual financing strategy or usual dividend distribution policy. Then it is called special dividend. But the moment you declare a special dividend, it has to follow all the provisions of law as well as Secretarial Standard or SEBI listing agreements. There is another concept of deemed dividend. since it's not covered under Companies Act as a matter of academic interest, deemed dividend is something which is prescribed under Income Tax Act, which says that if any advance or loan has been given to a company or a person where they have certain substantial interest, then that will be deemed as a dividend, but it is not covered under this provisions. So there are 10 sections under Secretarial Standard 3. The first deals with the sources of dividend, second with declaration of dividend, then entitlement of dividend, dividend kept in abeyance, payment of dividend, unpaid dividend, then revocation of dividend, preservation and registers with regard to warrants and dividend of the company. Then there are certain set of disclosures that are required in the annual financial statements. And lastly, whatever is applicable to the listed companies in India. If we see the definition of the sources of dividend, there are two ways in which dividends can be declared. One is out of the profits of the company or out of the free reserves of the company. Whether it is out of the profits of the company or it is out of free reserves, there are certain conditions that are applicable. What I have done is I have consolidated all the provisions, all the considerations that need to be given. For example, whether it is paid out of current year profits or previous year profits or accumulated profits, depreciation has to be accounted for the present year and also for all previous years. Similarly, setting off of losses for the current year and previous year losses has to be done out of the profits before any dividend is being declared. Thereafter, notional gains, unrealized gains, change in the carrying amount of assets or liabilities due to revaluation of assets at a fair value is also not required to be accounted for when we are taking into account the dividend declaration or the quantum of dividend. Similarly, revaluation of assets, and also if at all board of directors, although it is voluntary, but if board of directors want to transfer certain amounts to the reserves, then this will be taken out of the distributable profits. Similarly, there is a provision which says that there is no dividend from its reserves other than free reserves. There is no other elaboration as far as secretarial standard is concerned. It goes on and explains what does it actually mean. Also, there is a provision with regard to interim dividend, which says interim dividend can be declared out of financial year, out of the profits of the financial year, or it can be declared during the financial year or between the financial year and before the date of declaration of dividend. Even declare all the dividends which can be declared, we have to take profits up to that quarter. For example, if from April to June there is a first quarter, then when the first quarter is over, then there is a need to assess the dividend out of whether there are profits or not, and then dividend need to be declared after that. The biggest contribution under secretarial standard is that there is no definition of how the profits are calculated. Profits, when profits are calculated, they have to be seen as part of true and fair view of the profit and loss account. Whether the statement of profit and loss account has been prepared in accordance with general accounting principles. Also, whether all the applicable accounting standards have been applied for, and whether such profit and loss account is prepared in compliance with conformity with the laws or not. When we are considering the dividend, in case there is a non-compliance of the provisions related to deposits, whether it is the principal amount or the interest amount, it has to be considered before quantifying the dividend. If there is a default in the redemption of debentures or any interest thereof, or the creation of debenture redemption reserves, then also it need to be considered. Similarly, if there is a dividend payment default in past year or in the present year, that need to be considered. Similarly, default in term loans. If there is any default in the term loans, although it is not prescribed anywhere, but if there is a default in the term loans, then definitely there is a need to consider what to quantify as part of the dividend. Similarly, in terms of other than free reserves, since the dividend cannot be declared other than free reserves, the secretarial standard goes on to describe that there is no dividend which can be declared out of either securities premium account or revaluation reserves, or amalgamation reserves, or profits prior to incorporation. See, these are the factors which need to be seen before any dividend has to be declared or recommended to the shareholders. As far as interim dividend is concerned, before declaration of dividend, the board of directors need to satisfy themselves with the financial position of the company, whether it supports declaration of dividend by considering depreciation, any taxes, or anticipated losses, or dividend on preference shares. Although dividend can be an interim dividend, which can be declared anytime during the year. The board of directors must consider the dividend that is payable on outstanding preference shares of the company. Again, the concept of out of free reserves, again, if there are, the law clearly says that in case there are inadequacy of profits or in case of losses, how dividend can be paid out of free reserves. Generally, free reserves cannot be used for payment of dividend. However, in case of profits or in case of adequacy of profits, it shall be subject to a rate of dividend which cannot exceed 3-year average rate of dividend. Also, the withdrawal from accumulated profits cannot exceed 1/10 of the total paid up capital and free reserves. Similarly, first, all the losses has to be set off out of the free reserves, and then only dividend can be declared. The last thing is that free reserves should not fall below 15% of the paid up capital of the company. So these are the conditions. I have not seen many companies use this provision. However, it is there. Also, this does not apply to the government, where the paid up capital is fully owned by the government. There is another provision which is very interesting, that in case of loss during the current financial year, up to the end of the quarter, immediately preceding the date of declaration of interim dividend. In this case, law prohibits that dividend shall not be declared, out of the higher of the rate which has been declared for last 3 years. But imagine a situation if there is a current year in which there is a loss, and in case free reserves cannot be used. So this is to be paid out of only accumulated profits. There is no other way interim dividend can be paid out of free reserves. So this gives a window to only free reserves, only the amounts which are accumulated over a period of last many years, which has been carried forward to the balance sheet, to the profit and loss account, but not transferred to the reserves. Secretarial Standard 3 again goes on to describe that there is no interim dividend which can be declared or paid out of the free reserves. Final dividend may be declared out of free reserves. Why this? Again, interim dividend, there is no situation where interim dividend can be paid out of free reserves. So it just provides an additional clarification. Then going further in terms of declaration of dividend. Declaration of dividend has to be only at the board meeting. This is not prescribed under law whether it can be declared at the meeting or through circular resolution. But Secretarial Standard recommends that it's an important decision to be taken by the board. There are various factors that need to be considered, which need to be discussed at the board meeting before declaration of dividend. So therefore, it is highly recommended that the board sits properly and decides at the meeting on the decision of declaration of the board. In case there is an audit committee, it should first recommend the financial statements to the board, and then board should consider dividend only after consideration of financial results. Thereafter, dividend shall not be subject to, since dividend is irrevocable. It should not be subject to any conditions such as approval of the financial institutions or foreign collaborator or under any contractual obligations. Again, this is known that members cannot declare dividend. It is the board's discretion and the responsibility to ensure before declaring dividend that there are sufficient profits. So therefore, members cannot declare dividend. However, members can reduce dividend, not increase the dividend. Also, dividend declared by the members should be at the AGM only after adoption of results. It should not be before the adoption of the results. Dividend, final dividend should be declared. Thereafter, then secretarial standard also specifies that there is no dividend on equity shares for previous year, in respect of which financial statements have already been adopted by respective AGMs. So if AGM has already approved the dividend for particular financial year, I cannot go back in the past and declare dividend out of the profits which has been already adopted at, for the financial statements which has already been adopted at the respective AGMs. Similarly, AGM areas on dividend on preference shares for previous years can be declared as dividend. This is also clarified in the secretarial standard that before any dividend is declared, we have to also reckon with the dividend on cumulative preference shares. Dividend on discount coupons, for example, many companies do issue discount coupons, although any sort of profits or any sort of gifts are prohibited under secretarial standard for meetings. But here it goes to explain that in case there is any dividend which is any gift or discount coupon which is given, it should not be deemed as dividend. Again, to clarify, it specifies that capitalization of reserves or bonus shares cannot be issued in lieu of the dividends. Then it goes to there are routine issues. I'm not going to dwell too much on this. However, entitlement of dividend is specified that it shall be paid only in cash to the registered shareholder, or shareholder can decide that the dividend can be paid to his order or to his banker. It can since cash here doesn't mean only cash. It only tries to say that no dividend should be paid in kind. So therefore, it goes on to elaborate. The Companies Act itself provides that this can be paid by check or warrant or in any other electronic mode to the shareholder entitled to the payment of dividend. Thereafter, it also specifies again, as we started, that company will continue to have right to capitalize its profits or reserves. It's not prohibited to issue bonus shares when dividend has been declared. Secretarial standard goes on and specifies that it consolidates everything which is written under listing regulations or Companies Act, that all the shareholders or the beneficial owners who are members as on the record date or on the book closure dates are entitled for the dividend. Again, preference shares will have priority over dividend whenever dividend is declared. If at all preference shares have been allotted, then it has to be considered and given priority. If there are multiple class of preference shares, then if the terms of issue are silent on priority, dividend has to be paid on a pro rata basis. Whenever there is any dividend which is considered, the board should take into account whatever is necessary to pay the dividend to the preference shareholders. Again, to come back to the same issue, if an interim dividend is declared and if there is an outstanding preference shares, board should estimate whether the profits would be sufficient enough to pay to the preference shareholders before declaring any interim dividend. Similarly, if there are any arrears on dividend on cumulative preference, that should be accounted for before payment of any dividend on equity shares. As all of us know that participating preference shares, if has been issued, then the right to participate in the residual profits also lies with the participating preference shareholders, where dividend is issued to different class of shares. For example, if there are differential voting rights in terms of dividend, then the dividend shall be paid in accordance with the terms of the issue of those shares. Although listing agreements have not is silent on this. If at all there is any registration pending on the transfer of shares, law prohibits, law allows companies to keep the dividend in abeyance, and in case the instrument of transfer is delivered and it is impending transfer to the dividend to unpaid dividend account. Also, it simply says that in case registered shareholder can write to the company to pay such dividend to the transferee as well. However, Secretarial Standard specifies that before accepting any instrument from registered shareholder, the company need to assess whether the instrument is valid, and if there is at all issue of validity, then no action should be taken with regard to order of the transferor to pay dividend to the transferee. Similarly, in case the shares are pending for transfer, or there is any dispute or prohibition orders on any statutory authority, then dividend should be kept in abeyance, and it should be transferred to the unpaid dividend account when it is falling due. Now, this is the most important provision for dividends, and there is a lot of clarifications which has been issued by under the all these principles need to be reviewed by all the company secretaries before or the board of directors before payment of any dividend. It simply says that if there is an amount which is declared as a dividend, it should be deposited within 5 days from the date of declaration of such dividend. Now, there are issues with regard to if a company declares 3 dividends in a year, it is not compulsory to open 3 bank accounts. It may be that one account is opened, and as and when the dividend is required to be moved to unpaid dividend account, after that this dividend can be this account can be again used for payment of another dividend rather than opening another dividend account. However, companies do follow different practices, and those practices are also fine. Only the thing is, later on, when there is a reconciliation which is required on a yearly basis, the multiple accounts becomes an issue while dealing with the number of bank accounts. Similarly, the 5 days when we count it, if there are any intervening holidays which are falling due during such period, it shall be included. It cannot be excluded. And then Secretarial Standard also specifies that such dividend shall be paid within a period of 30 days. While Companies Act Section 124 says that if it is not paid within 30 days, then it has to be transferred to a unpaid dividend account. But it provides a requisite clarity. Similarly, dividend deposited shall be utilized only for the payment of dividend or for transfer of unpaid dividend account or to IPF, and should not be used for any other purpose. Again, it doesn't apply to government companies. They do not need to open a separate bank account for those companies where they hold fully paid up equity share of the company. The taxation laws have changed. Earlier, there was a dividend distribution tax. Now, dividend declared and distributed on or after 1st of April are taxable in the hands of recipient shareholders and subject to TDS if the amount exceeds threshold prescribed in a year. Let me tell you, this appears to be very simple, but if a company is having 100,000 shareholders or 200,000 shareholders or 2 million shareholders, the administration of dividend tax is a big headache, and it requires not only very careful examination of the various slabs which are applicable to different class of shareholders, but it also put additional administration administrative hassle on the company to ensure that the TDS certificates, etc., are dispatched to all the shareholders either through electronic form or through dispatch by registered post or speed post. Again, it clarifies that when dividend is distributed, it should be in cash and it should not be in kind. Also, it goes on to specify that to curb any fraudulent encashment, the endeavor should be to pay dividend directly to the bank account, either through ECS or direct credit or RTGS or NEFT, etc. And intimation should also be sent to the member to that effect. If it is not possible to declare to pay dividend through electronic mode, then such dividend shall be paid by way of check payable at par or dividend warrant. Again, there are host of requirements in terms of what should be printed on the dividend warrant, like if at all a check or warrant has been sent to the registered address of the member. In case it is a joint shareholder, then it has to be sent to the first named member or to such other person or such other address as member or joint holders have directed in writing. Then what should be printed on the dividend warrant? So name of the bank and the account number should be printed. Also, if this is not available, then address of the member need to be printed on the dividend warrant to avoid any fraudulent claim on the dividend warrants. Similarly, if the dividend warrant or the check is above rupees 1500, then it needs to be dispatched either by speed post or registered post. In case of Nidhi companies, I think where dividend payable to a member is rupees 100 or more, it specifies that it should be sufficient compliance if the declaration of dividend is announced in the local language in one of the local newspapers. Again, nowadays, as per the RBI norms, the validity of the dividend warrants is only 3 months. There is a revalidation which is required after 3 months upon request. Companies do also do not revalidate the dividend warrants nowadays. They simply issue a demand draft. However, issuing a demand draft means the account is debited at that time and it needs to be later on reconciled with the bank statements whether the demand draft has been encashed by the company or not. There is a need to maintain all the registered of dividend warrants, as well as in case duplicate dividend warrants are issued, then there should be maintained a register of duplicate warrants also. I'm not going into punishment or failure to comply with the laws. It is provided under law, which is very clear. Again, when we are sending dividend warrants, it should be accompanied by a statement which specifies the dividend amount, the details of folios, client ID numbers, etc. Unless dividend unless the articles provides the dividend shall be paid in proportion to the amount paid on the shares and for the portion of the year of the financial year in respect of which it is paid. Also, there are certain circumstances in which if a company is not able to pay the dividend, then Section 127 specifies certain specific exemptions that if a dividend could not be paid by reason of operation of any law or direction given by a shareholder cannot be complied with, or if there is a dispute or the dividend is lawfully adjusted against the sums which are pending towards that shareholder, or for any other reason, the failure to pay the dividend or post the check or warrant within the prescribed time was not due to any default on the part of the company. This is a severe. For example, during COVID times, there were occasions when dividend warrant couldn't be dispatched to the shareholders, although there was an exemption given. However, this provision had helped many companies to avoid any default in terms of dividends. Again, if dividend is not paid within 30 days, it is required to be transferred to unclaimed dividend account within 7 days from the date of expiry of 30 days. Also, within 90 days, there is a need to file a statement. Also, upload a statement on the website with name, address, and amount due on the website of the company. Also, members may apply to claim the unpaid, unclaimed dividend after transfer. If the amount is not transferred within 7 years, then it shall be transferred to IPF along with interest thereon, if there is at all any interest which has been accrued on that. I'm sorry. So when the dividend is transferred to IPF, there are certain requirements which are there. For example, the statement, it doesn't specify whether that statement should continue to be on their website. Secretarial standard clearly specifies that if such statement if the amount has not been paid, it should be updated on the regular basis on the website. Then any transfer to IPF shall be made within 30 days from the expiry of 7 years from the date of transfer of unclaimed or unpaid dividend to the UDA, which is unpaid dividend account. So there are number of requirements which are specified under secretarial standards. In the interest of time, I'm not going through everything. There is a specific mention that in case there is a specific order of the court or tribunal or any other statutory authority restraining such transfer, then such details should be also filed with the IPF authority within 30 days from the end of the financial year. Also, filing of statement with IPF authority within 30 days of the end of each financial year has to be done. Also, a statement containing details of unclaimed or unpaid dividend due to be transferred to the IPF in the next financial year has to be filed with the IPF authority. So, once the amount has been transferred to IPF authority, there is a provision which says that any claimant which is entitled to apply for refund from IPF authorities after following the procedure prescribed for the purpose of claiming their dividend. Let me tell you, this provision looks very simple in terms of the language which is used. However, we know how much difficulties we are having in terms of when these claims are filed with the IPF authority. It takes a lot of time when these claims are processed by IPF authority. It could be due to lack of documentation on the part of a shareholder. There could be issues with the company. According to me, this need to be streamlined going forward, because it takes anywhere between 3 to 6 months, while there is a specific requirement to transfer certain amount within 5 days, 30 days, 7 years. When it comes to claims from the IPF authority, it is taking a lot of time in terms of the documentation and the administrative process followed by IPF authority. Even before transfer, the company is required to individually inform to all the members and also publish it in the newspaper at least 3 months before the due date of such transfer, in respect of whom such unclaimed dividend is being transferred. All these details are also required to be uploaded on the website of the company, and no transfer of shares or dividend should be there in case there is any specific order of the court or tribunal or statutory authority, or there is a pledge or hypothecation marked as per the Depository Act. On the revocation of dividend, dividend once declared becomes a debt and it shall not be revoked till the time the dividend is not declared. It is in the consideration of the board of directors, or if it is recommended and not approved by the shareholders, it is okay. But the moment dividend is declared, it becomes a debt and it cannot be revoked by the company. With regard to the preservation of dividend checks, warrants, and dividend registers, it is required. We are required to maintain checks, dividends, which are returned by the bank after payment thereof, and there is a need to maintain dividend registers for a period of at least 8 years. If there is a undertaking given to the bank for preservation of or safety of the dividend checks or warrants for a specified period, then the instrument shall be preserved for such specified period or 8 years from the date of instrument, whichever is longer. So also in case dividend checks or warrants are destroyed, only should be destroyed with the approval of the board of directors or in accordance with the policy approved by the board of directors for this purpose. In terms of disclosures, there are specific disclosure under the Companies Act, which says that the amount, if any, which is recommended, should be paid by way of dividend need to be disclosed. Secretarial standard specifies that notes to the account shall disclose the aggregate dividend proposed to be distributed to equity and preference shareholders for the year, and also the related amount of dividend per share. If there is any arrears of fixed cumulative preference cumulative dividend on preference shares, it shall be disclosed separately. Again, in the balance sheet, the current liabilities and provisions should specify the amount lying in the unpaid dividend account together with the interest accrued thereon. Also, the amount of interim dividend, if any, to be paid during the financial year, and final dividend recommended by the board of directors shall also be disclosed in the board's report. As far as the annual report is concerned, it should disclose the amount lying in unpaid dividend account in respect of last 7 years, and one such unpaid dividend is due for transfer of IEPF. The amount of dividend, if any, should be that is required to be transferred by the company to IEPF during the year also shall be disclosed in the annual accounts of the company or annual report of the company. So there are a host of additional compliances under Companies Act, under listing regulations, which are required to be followed by all the listed companies. It first talks about the rights of the dividend, what kind of if the allotment of shares shall rank pari passu with the existing equity shares. There is no issue of shares which may confer any person any superior rights in terms of voting or dividend, as I shared earlier. There is a prior intimation which is required to the stock exchange. These are all very routine compliances, but have to be considered while taking into consideration while making any decision on the dividend. Like 2 working days has to be reckoned with, which has to exclude the date of meeting and the date of the intimation to the stock exchange. Also, in terms of record date, it is at least 7 working days in advance. It excludes the date of intimation and record date. Similarly, when we are making any recommendation or declaration of dividend, at least 5 working days before the record date fixed for the purpose. So it should be carefully calculated, the times, etc., because stock exchanges are sometimes very strict. They do not allow any exemption or dispensation from any of these requirements. Similarly, when the dividend is declared in some meeting, then within 30 minutes from the closure of the meeting, it has to be informed to the stock exchange. Similar to other requirements, if there is the check payable is exceeding rupees 1,500, then it has to be dispatched by speed post. The company should declare the dividend on per share basis as well. In case the company is having forfeited shares, then forfeited unclaimed dividends before the claim becomes barred by law, and such forfeiture, if affected, shall be annulled in appropriate cases. Also, top 500 companies are required to have a dividend distribution policy, and such dividend distribution policy shall be disclosed in the annual report of the company and be placed on its website. last not but the least, the company shall disclose in its corporate governance report the dividend payment date under the general shareholder information. So I will stop there, and in case there are any questions, we'll take it up later. Over to you, Sharda Madam.
Thank you so much, Pramod. Indeed, that was a very clinical presentation. I would say very, very comprehensive. You touched the Companies Act, the standards in particular, the best practices for a listed company. And also, I appreciate that you also highlighted some of the compliances under the income tax. This topic is so very relevant. The timing of this session also is very relevant in considering the part of the year we are in, where most companies will be planning or have already declared dividend. I think your presentation is the kind of a checklist of do's and don'ts. And if you are willing to, if you share it with the members, I'm sure they will appreciate it. Yes. So, Pramod, just for your information, even as you started batting, there are a lot of questions which have been posted. It's already there in the chat. You have the luxury of going through and being prepared. By when we move on to the second speaker, already about 9,600 people have logged in. I'm sure with Narayan Shankar's presentation on the board's report, we will soon cross that 5-figure mark. Thank you so much, Pramod. Now we move on to the next speaker. That is, we have CS Narayan Shankar, who will be presenting on SS-4, that's board's report. It's my privilege to introduce such a senior, seasoned veteran company secretary as Narayan Shankar. He's an associate member of the institute. He holds a bachelor's degree in commerce and law from the University of Mumbai. He has over 25 years of very rich experience in corporate laws and legal affairs. Mr. Narayan Shankar joined Mahindra & Mahindra in the year 2001 and is currently the executive vice president and company secretary. He heads the secretarial compliance function for the entire group, and he is also on the board of various Mahindra Group companies. He is a member of the expert group on secretarial standards, and in the past was on the various committees set up by MCA, SEBI, and also in the past he was a member of the secretarial standards board until he was questioned as expert group. Mr. Narayan Shankar plays a very influential role in raising the corporate governance standards of M&M to its current level. Interesting to note that during his stint at M&M, the company has twice been recognized with the Golden Peacock Award for Best Corporate Governance and Best Governed Company, twice from ICSI. I think we must hear it for both Mr. Narayan Shankar and the company. He has the distinction of representing the industry on several occasions with regulators such as MCA, SEBI, and depositories to take up the issues faced by the industry. On a personal note, again, thanks to pandemic, though we have been on this group for the last 3 years, have not been able to meet you in person. But I always feel there is that warmth and goodwill which transcends the distance between Mumbai to Bangalore, cutting across all time zones. And I do feel touched when you, even if it's a late night, you send in a message if somebody is not well or if we have done well in something and you want to pay your compliments. That's the personal warm side of Narayan Shankar that I have observed. But now we will have a great session to look forward to, because he's a very experienced member and very actively participates in all the deliberations. Over to you, Narayan Shankar, for the topic on board's report and significance of SS-4.
Thank you. Thank you, Shada, for those kind words. Is the presentation visible in the...
Yes, it is visible. Please go on.
Okay. Okay. So the topic today is, which assigned to me, is board's report. Pramod has very nicely covered SS-3. Now it is for me to cover the board's report, and we'll be going through in generic first about the board reports, and I will require some time because I am going to touch upon certain matters, whether it is in terms of revision of financial statements, how the 134 to be read with 131, certain matters relating to related party loans and investments, dividend again as part of the board report, and then we move on to the other aspects of board report. To start with, as rightly pointed out even by Pramod in his disclaimer, same applies to me. Views are of my own and not of that of the organization. And even in the course of today's presentation, if I make reference to any person or any company, it is only with the intention of learning a lesson or two and never being critical about anybody. Okay, with this, let's start. Board's report is an important means of communication by the board of directors of a company. It provides stakeholders with both financial and non-financial information about the company and its performance, and it should relate to the financial year for which such financial statement is prepared. The board reports provide stakeholders with financial and non-financial information, including performance and prospects of the company, relevant changes in the management, changes in capital structure, a recommendation as to distribution of profits, future and ongoing programs of expansion, modernization, diversification, capitalization of reserves, further issue of capital, and other relevant information. Okay. And if we go into the laws governing the board's report, while you have the Companies Act, which is mandatory, SEBI LODR, again mandatory, and other sector-specific laws you will have, whether it is RBI, IRDA, POSH, etc., which again would be sector-specific, depending on the industry to which the company belongs to. And of course, you have the SS-4 and guidance note. And I think it's come out. In fact, I feel the manner in which the SS-4 and guidance note is of huge value add, I personally feel, for every of our professional. In fact, the annual report, while we talk of board's report, it will also have MDA, BRR, which is now BRSR, the corporate governance report, and of course, notice and explanatory statement, which forms part of our annual report. Okay, the SS-4 and GN, that guidance note, virtually touches upon every aspects of the board report, whether it is approval, signing, how do you do filing of board report, what are the matters of subsidiary companies, managerial remuneration, dividend, corporate action, vigil mechanism, penal provisions, disclosures under various sector-specific, examples being given, policies required by the company, CG report, MD&A, PRR, which is now BRSR. In fact, just on this point, as you're aware, secretarial standard is a unique and pioneering steps of ICSI towards standardization of diverse secretarial practices. In fact, earlier, today you have social media and others which keeps you connected to a great extent. Earlier, we had to really go for certain seminars and sessions where you will come to know how other companies or what is the practices being done by other companies. But secretarial standards today gives virtually doorstep delivery to everybody, because all the diverse and the best practices of all the corporates are culled out, brought into a single document called SS and doled out to the members. In fact, guidance note explains procedural and practical aspects. It gives various illustrations. It gives various examples. It gives you templates. It gives you FAQs. In fact, we have questions raised by various of our members on various matters, whether it is on board report or other matters, and what are the practical difficulties they are facing. Each of them is then culled out as an illustration. Each of them is culled out with an example, including how do you disclose it in the board's report. Having gone through the basic, I will now go into specific, and I want your attention on certain points which are very valid and valuable for at least the company secretary when he is going to go through the rigmaroles of compliance. And the very first item I want to touch is voluntary revision of financial statements. Okay, as you're aware, what are the disclosures required to be made in respect of financial statements or the board report when it comes to revision of financial statements? As you're aware, in case the company has revised its financial statements or board report in respect of any of the 3 preceding financial years, either voluntarily or pursuant to an order of a judicial authority, detailed reasons of such revision has to be disclosed in the board report of the year as well as in the report of the relevant financial year in which revision is made. 131(1) provides for revision of timelines financial report, statements and report after the company has obtained approval of the tribunal. Such revised financial statements or report has to be prepared, can be prepared and only once. That means you can't be doing it more than once in a financial year. And detailed reasons have to be disclosed in the board's report of the relevant financial year in which such a revision is being made. Such detailed reasons will also include financial impact, if any, due to the revision of the financial statements. In fact, 131(2), subsection 2, provides that if the previous financial statement or reports have already been sent out to the member, or if it has already been delivered to the registrar or laid before the company in the general meeting, the revision will have to be confined to correction in respect of which previous financial statement or report do not comply with the provisions of 129 or 134, and making of any necessary consequential alternation. Okay. Now, what is the key difference between voluntary or revision in financial statements vis-a-vis reclassification and restating prior period items, which we call? Okay. So here, what we have to first ensure to see that along with 134, you have to see the provisions of 131. And as you're aware, under 131, if it appears to the directors that the financial statement of the company or the report of the company do not comply with 129 or 134, then they may prepare revised financial statements or a revised board report after obtaining approval of the tribunal. In fact, it's a very elaborate process. Tribunal gives notice to the RD, ROC, income tax authorities, and it is done in a very transparent manner. And detailed reasons, as we saw on the earlier slide, for revision of such financial statement or board report will have to be disclosed in the board's report in the relevant financial year in which the revision is being made. So the key question is, how do you differentiate between what we call revision, reclassification, restatement? Because a lot of times, as company secretaries, you will be put out that it's a genuine error. It does not require Nclt approval. This does not fall into the clutches of 131, etc. So what is the difference? First, let us see between reclassification and restatement, for example. A restatement, friends, is the restatement of financial statement. It is proposed to correct what was previously reported erroneously, I can say. A reclassification would involve correcting classification of a transaction or entry or moving it probably from one vertical to another. For example, one could reclassify an entry from a current asset to, say, a long-term asset. What is the difference between revision and restatement? A revision, friends, is the correction of a reported amount in subsequent financial statements. However, in this case, the previously reported financial statement need not be reissued. With a restatement, on the other hand, the error has to be material, prompting a revision and the issuance of a corrected financial statement. Hence, a restatement is an act of revising one or more of the company's previous financial statements to correct an error. Restatements are necessary when it is determined that a previous statement contained a material inaccuracy. So the key question is that, is this restatement, is it resulted from, or what are the questions the CS has to ask when such a point comes to it? Is the restatement resulting from, say, accounting mistake, a mathematical mistake, mistake in applying accounting policies, oversights and misinterpretation of facts? Is it on account of a fraud? And the most important for a CS, has there been any non-compliance of 129 and 134? And what do we mean by this? Is that anything hinting that the company had not applied accounting policies and accounting standards prescribed under 133, and leading to a conclusion that the earlier year's financial statements may not be reflecting a true and fair view of the financial position and financial performance of the company. So a lot of times you need to see if reclassification is falling within the clutches of 131, and hence we need to say, first, what do you mean that the financial statements and board report do not comply with 129 and 134? Once you come to that basics, the other is just a matter of routine and procedural. So let us just try to peel the onion. Section 129 requires financial statements to be prepared in compliance with accounting standards prescribed under 133 of the Act. 134 prescribes the manner of approval and authentication of financial statements and the board report and the contents of the board report. And one of the important ingredients of the board report covered under 134 is what we call DRS, which is Director's Responsibility Statement. And what is one of the important ingredients of DRS? It is that the directors have selected and applied accounting policies and accounting standards consistently and made judgments and estimates that are reasonable and prudent so as to give a true and fair view of the state of affairs of the company at the end of the financial year and of the profit and loss of the company for that period. Similarly, would the restatement, if it comes to a company secretary and say that this does not require Nclt appeal, this is not tantamounting the revision of accounts, would the restatement of accounts have any impact on adequacy or implementation of internal financial controls laid down by the company in terms of policies and procedures adopted by the company for ensuring orderly and efficient conduct of its business, including prevention and detection of errors, the accuracy and completeness of the accounting records, and the timely preparation of reliable financial information. Reopening and revision of earlier years' financial statements would be required in cases where there is discovery of errors, including fraud, or facts and circumstances that came to light lead to a conclusion that the earlier financial statement actually is not reflecting a true and fair view of the financial position. Okay, so many restatements will come across to the company secretary or will try to be passed on to the company secretary as if it is a result of innocent mistake and basic misinterpretation. So each time a question is raised in this regard, while you are preparing your board's report, while you're doing your annual report, and there is a restatement, we need to ask, was it an innocent mistake or was it something that appears to be more sinister? Is it raising red flags, highlighting potential fraud or intentional suppression of facts? How is management confirming as to how it plans to stop similar mistakes from happening in the future? If it is a prior period error and if it is considered material, it would need restatement. The key question which a CS has to ask whether this material error is getting into the clutches of Section 131. This material error will be deemed to be getting into the clutches of 131 if the correct information would lead those, how does Sebi put it is, if the incorrect information would lead to probably innocent investors receiving the statements to come to probably inaccurate conclusions. And what do you mean by this? Can we give some examples? Yes. For example, if this restatement of accounts leads to over-reporting of a company's gains, investors to believe the company is in a stronger financial position than is actually the case. Investors performing actions based on inaccurate information in regard to some previously made investments than otherwise would have been the case. The financial statements being perceived by investors are misleading, then clearly the earlier financial statements may not be reflecting a true and fair view of the financial performance. It is also worth remembering that changes in certain financial estimates may not be required if these are based on anticipated events and not ones that have already occurred. So these changes must be reported in the next financial statement after the change is made or after the event and not applied retrospectively. So just to conclude, before the CS gets into disclosures in the board report, he or she must make sure that the rectification of the prior period error coupled with other facts and circumstances which the CS will go through, that has come to light, and make sure that this rectification neither vitiates the true and fair view of the earlier years' financial statements as they reflected the position based on the facts and calculations that management was aware at that point of time, nor has it had any impact on adequacy or effectiveness on the internal financial controls laid down by the company. And this can be substantiated by various means. Say, for example, was the period, can it be the prior period error? Could it be classified as one caused by oversight in computation of the amount? There has been no failure on consistent application of accounting policies or accounting standard. The error being corrected is not material, and external investors have not been adversely impacted. Restatement would neither lead to the investors to believe that the company was in a stronger financial position, nor it will be perceived as misleading. There is no impact on other stakeholders like tax authorities, lenders, etc. No dividend has been paid out of the company, or no fresh shares have been issued on account of this. There is no element of fraud. There is neither a case of mismanagement nor a case of suppression of facts, rendering accounts of past profit unreliable. So these are probably checks and balances which a professional can do before really getting into actual disclosures and before getting into whether such reclassification, restatement would come within revision of financial statement as mentioned in 131. We will now shift gear immediately. Time is short, and I will go through some of the provisions of related parties and loans and advances with specific reference to the board report. As you are aware, whether related party transactions are required to be disclosed in the board report, yes. Particulars of contracts or arrangement with related parties under 188(1) in form AOC2 has to be disclosed in the board report. AOC2 is prescribed under Rule 8.2 of the Company Accounts Rules 2014. Section 188(2) provides justification for entering into contract or arrangement with related parties under 188(1) is also required to be disclosed. Okay. So here is where just wanted to give you a few examples of what is the value add we do in terms of all the deliberations we have at the expert group. For example, heading of form AOC2, which is that is form of for disclosure of particulars of contracts or arrangement entered with related party. It has a term called including certain arm's length transaction under third provision thereto. Form AOC2 is divided into two: details of contracts or arrangement not at arm's length and details of material contract or arrangement at arm's length. In fact, here the guidance note defines and tries to help professionals. What is the word certain in the heading of AOC2, read with point 2, should be interpreted? It should be interpreted to mean disclosure of only those transactions which are on an arm's length basis, however, breaching the thresholds of materiality. Those have to be disclosed in form AOC2. As you're aware, word material have the thresholds are already mentioned in 188 read with rules, and company secretaries could be guided by those. Second change, which has come from 1st Jan 2020, as you're aware, all related party transactions require prior approval of the audit committee, and only members of the audit committee who are independent directors have to approve the related party transactions. So these disclosures would also form part of the board report. When it comes to what if the board has not accepted recommendation of the audit committee, two provisions, 177(8) and 134 true, which both gives you a hint that if the board has not accepted any recommendation of the audit committee, the same has to be disclosed along with reasons therefore. Similarly is the case with 134 true. Okay, so the key thing, interpretation, which the guidance note helps is which are those disclosures, which are those recommendation, which if not accepted will require a disclosure in the board's report. And if you say with examples, the guidance note has given, for example, if the transaction in OCB and arm's length, and approved by the audit committee, no disclosure is required. If the transaction is in ordinary course and arm's length, but not approved by the audit committee and referred to the board with a positive recommendation. Here, the guidance note beautifully prescribes that if the board disapproves such a transaction, disclosure is required for not accepting the recommendation of the audit committee. Third example, transaction is in the ordinary course and its arm's length, but not approved by the audit committee and referred to the board with a negative recommendation. In such a case, if board approves the transaction, disclosure is required for not accepting the recommendation of the audit committee. Fourth, transaction is in the ordinary course of business, arm's length, but not approved by the audit committee and referred to the board without any recommendation. Here again, we have clearly clarified no disclosure is required at all. Second question, coming even very important with regard to both board's report and notes, is that is the difference between every modification of related party and material modification. Okay. And the key question is there any dichotomy between the new regulation 23.2 of LODR and 177.4 subclause 4, subsection 4, subclause 4? There is no dichotomy because the ambit today, what you have to realize is the LODR has widened the ambit of RPT. Mind you, it is not RP, that is not related party. They have enhanced the entire periphery of related party transaction has been enhanced to include even subsidiary level transactions, as you are all aware. RPT covered under 177 as well as 23. Initial transaction as well as every modification will require approval of audit committee. For additional categories of RPTs like subsidiary level transaction of RPT, which is with the RP of a subco, approval for the transaction as well as any subsequent material modification would be required. Is there any dichotomy between Regulation 23.2 and Schedule 2, Part C, Part A of LODR? Schedule 2, as you're aware, of LODR requires audit committee's approval or any subsequent modification of transactions of the listed entity with related parties. Here we need to know there is no reference of the new wider definition of RPT over here. Rather, it is restricted to transactions with related party. That means transaction of the listed entity with the related parties. Whereas 23.2 requires audit committee approval in case of all RPTs and subsequent material modification. Okay. Now, before we get into the other point, the one point which is going to come with effect from 1st April 2023 is what we call the purpose and effect test. Okay. And here you will find from next year, we will have to, company secretaries would have to really struggle to a lot of disclosures which would need to come both in the annual report, board report, notice, explanatory statement, and how do we go about? And one of them is this, which what we call as the purpose and effect. To put it very simply in this particular chart, if a listed entity or a subsidiary of a listed entity has any transaction with the unrelated party, mind you, it is any other person or entity, the purpose and effect of which is to benefit a related party of a listed entity or related party of a subsidiary also. It is requiring to go through all the rigmaroles of all the requisite approvals under 23. This is regardless of whether a price is charged, regardless whether transaction should be construed to include a single transaction or a group of transactions in a contract. And here we will need to see some examples of saying how this purpose and effect test would really have to go through. As you're aware, the language is purpose and effect, both of which would need to come into play when the related party transaction is being done. So let me give you a few examples so that we understand how it is going to play out. One, you have a case of a listed entity transferring a business to an unrelated party, and say after a particular period of time, such unrelated party is acquired later by the subsidiary of a listed entity. At the time of hiving off, neither the purpose nor effect test is passed. So hence, as part of the core group, you should say how we could put broad bright line test in this regard. Second, as you're aware, this is also quite common. Listed entity sourcing metals, parts of engines or parts for itself, or even you can say power purchase agreement, is done by the listed entity sometimes to secure itself and all the subsidiaries. Okay, and if you are acquiring, suppose, parts or metals from a completely unrelated party, it could be in European Union, any of the Asian countries, you will be acquiring, but because you need to have synergies and economies of scale for the group, you may be doing a transaction or you may be ordering materials for you as well as the subsidiary. Correct? So here the purpose and effect both is actually intended to benefit the related party, that is your subsidiaries or associates. Even if you can say the unrelated party gives directly the metals to the subsidiary, and even if the subsidiary makes directly payment to the unrelated party, doesn't make a difference, so long as at the time when you're doing an agreement, the purpose and effect of this is to materially, is to what you can say benefit a related party, which is your subsidiary. The same example, you can switch it of saying, instead of the listed entity doing, what if the subsidiary of the listed entity books a contract for the same metals or parts, and that is done for, say, even for the listed entity. Here again, the metals could be transferred directly to the listed entity, and payment could also be made directly. In this case, since it is done by the subsidiary, approval of the listed entity will be required because there is threshold of 10% of 1,000 crores, the 1,000 crores, whichever is less, based on which you will have to go and seek approval of the audit committee, and depending on the threshold, the shareholders. The whole purpose of giving this is we need to have very clearly, there will be multiple examples which will come like this. And how is it that we need to say, ensure that both the purpose and effect test is met? And how do you meet it if it is not there at the time when the transaction is done? Second, which I wanted to make a mention is on the wholly owned subsidiaries. 1 minute. Okay. And as you are aware, for the purpose of 23(5), there are exemptions given to the company and the wholly owned subsidiary, as well as between two wholly owned subsidiaries. So it is very important that we defined what is a wholly owned subsidiary, or clarification is sought. For example, for the purpose of 23(5), a wholly owned subsidiary should actually mean a subsidiary where the entire economic interest is held by the parent listed directly or indirectly through one or more subsidiaries. As you're aware, a company can hold 100% interest in a subsidiary, either directly or indirectly through one or more subsidiaries. If you see the key, when you are defining a subsidiary, aggregation of the holding company and subsidiaries is involved. This aggregation is not coming out clearly in the whole definition, rather it is not defined at all, when we are coming to see what is a wholly owned subsidiary. For example, one view clearly coming out is a wholly owned means I need to wholly own. I need to have complete 100% control or 100% shareholding in that company. Then it is a wholly owned subsidiary. Similarly, if I have 100% in the subsidiary and the subsidiary in turn has 100%, that will be a chain of wholly owned subsidiaries. But the key difference will be if I, along with my subsidiary, say 60-40 together hold a third subsidiary. It will not come squarely sometimes within the clutches of wholly owned subsidiary, because we are saying there is no single parenting. One of the tests you have to always do for wholly owned subsidiary, is it a single parent or is it a dual parent? If there is a single parent, it's a wholly owned subsidiary. Hence, a clarification would be required, and where ICSec and definitely expert group can liaise with SEBI and help them out to the effect that if the entire economic interest in the subsidiary is ultimately held or owned by the parent company, it could be directly and or together with one or more subsidiary, it should be considered as a wholly owned subsidiary for the purpose of 23(5). And in fact, this is in line with SEBI's informal guidance which they had given for one of the companies, but this interpretation was taken for the meaning of wholly owned subsidiary vis-a-vis Regulation 37 of the LODR. The next point is only corporate actions by listed entity is exempt. As you're aware, if you go to the definition, one of the key things which we have highlighted over here in the slide also, corporate action by listed entities which are uniformly applicable to all shareholders are exempt. That means the corporate action has to be by the listed entity, whether it is payment of dividends, subdivision, rights, bonus, buyback, anything. So what is the key thing is, if it is not a corporate action done by the listed entity, it is not exempt. For example, if you get dividends, say, of more than 1,000 crores from your subsidiary, it would require approval of shareholders because the exemption given here is only corporate actions by the listed entity. And what problem this would create to the entities or company is that merely receiving dividend from a subsidiary of more than 1,000 crore would require approval of shareholders. And not only that, what you need to really think care is, if your dividend itself is crossing 1,000 crore, then every single rupee transaction thereafter with that particular subsidiary, whether it is investment, loans, borrowing, guarantees, it could be transfer of resources, deputation of personnel, it can go on. Everything of that would then fall within the clutches of prior approval. Okay, so hence it will really help that if we could probably do a clarification to state that the exemption would equally apply to transactions where the listed entity is also in recipient of dividend or its receipt of securities from related parties, so long as the logic could be the same, so long as these are uniformly applicable or offered to all shareholders in proportion to their holding. So long as that logic is applied, we should also see how we could probably represent together to SEBI to say that, and of course, they are going to listen to genuine concerns of ICSI. Okay. The next point comes to about the 8th April 2022 circular of SEBI, which talks about omnibus approval of shareholders. As you're aware, Regulation 23(3) of SEBI LODR specifies that omnibus approval granted by audit committees shall be valid for a period not exceeding 1 year and shall require fresh approval after expiry of 1 year. 23(4) requires shareholders' approval for material related party transactions. And SEBI had gone out of their way to help industry to say that in order to facilitate listed entities to align the process to conduct AGM and obtain omnibus approval, it was decided that shareholders' approval of omnibus RPTs can be obtained in AGM, which shall be valid up to the date of the next AGM or for a period not exceeding 15 months. So what is this exactly? There was no concept of omnibus shareholders approval in Regulation 23. And the key question is repetitive and similar transactions, whether it is like purchase of goods, sale of goods, purchase or sale of services, loans, investments, guarantees with a related party is taken up with the audit committee with, say, an estimated value during a financial year. And that is what we call as, which comes to the omnibus rule. What was the background of this 8th April 2022 circular? The industry had raised concerns that audit committee would grant omnibus approval, and that would be for a financial year. Companies may not have all the information that is sought by, if I'm not mistaken, it's a 22nd November circular of SEBI. Companies may not have all the information. But when companies have budgeted the amounts for omnibus approval for audit committee, it may appear to the company that one or more of them could cross probably the lower threshold of 1,000 crore. And hence, Could SEBI help in this regard? And what was the third point raised to SEBI? It was that it would be quite a humongous task for companies for taking approval. Say till 31st March 23, you have taken approval. And then again taking approval next year if it crosses the 1,000 crore before the next AGM. And again, you will have to go for an EGM or a postal balance, as the case may be, because the threshold may be crossed before the next AGM. And this, industry said, would be a perennial problem for all companies year after year after year. And here is where I thought SEBI came to the rescue of industry by clarifying that in order to facilitate listed entities obtain omnibus shareholders approval for material RPPs, you can move from year to year and take approval from AGM to AGM, so that in between you do not have to go again back to the shareholders. This, in a manner, friends, paved the way for companies to seek RPT approvals from financial year, move from financial year to AGM, at least vis-a-vis the shareholders. But the key issue which I find is that many companies have interpreted this circular, which is enabling, which actually was meant to facilitate industry. Many companies are interpreting the circular as an absolute upper limit of AGM to AGM or not exceeding 15 months. This is was never the case. SEBI had come actually to help industry so that you don't have to go 10 times in between. This circular is enabling, and according to me, it no way restrains companies from seeking specific RPT approval. For example, where you have contracts or agreements or arrangements with related parties with say 5, 6, 7 years. There are contracts, say you will have power purchase agreements, your specific parts in an automotive company, engines or spare parts, which may be for larger periods, and you could definitely approach shareholders for such a larger period. However, as you're aware, proxy advisors do not recommend voting if the voting is in excess of 5 years, and companies have probably been adhering to this artificially, even though artificially pegging that period as 5 years, even though the actual agreement may be for a longer duration. If for some reasons companies have erroneously applied this either for a financial year, I think they should immediately at this AGM at least extend the validity of the shareholders approval at least up to the next AGM, so that they do not have to face any issues in the beginning of the next financial year, or so that at least they get reprieve till the next AGM. Friends, similarly is the case of the 30th March 2022 circular. Again, SEBI going out of the way to help industry. And let me tell you why. As you are aware, under 23A of LODR, what is 23A was a transitory provision which says that existing material related party contracts or arrangements within a reasonable period of time, and it is recommended actually that a company may prescribe frequency at which impact assessment is to be carried out for the completed project. Whether impact assessment needs to be done every year, again, timeline may vary from project to project. For some projects, assessment after 1 year of completion may be sufficient, but may not be for others. And impact assessment is to be taken for a project which have spends of more than 1 crore, and hence it will have to be done project-wise and definitely not financial year-wise. If impact assessment is done voluntarily, whether cost incurred on the same will qualify. Here, very important, provisions regarding impact assessment given in rules are to be read together and harmoniously. And if you do harmonious interpretation, impact assessment, if it is done voluntarily, then the cost will not qualify towards CSR expenditure. Whether impact assessment is going to be done on an ongoing project is required to be done only after the project is completed. If the project is ongoing or not yet completed, even if the outlay is exceeding 1 crore, impact assessment, as you're aware, is not mandatory. Whether impact assessment report of all has to be annexed, as you're aware, we have all, MC has clarified, you could give a summary of the impact assessment in the board report and give the detailed impact assessment in the board report. Okay, sorry, the summary can be given and you can give a web link. Disclosure of ongoing projects, very important. As you're aware, if you have an ongoing project and say your entire amount allocated is 1 crore, amount spent is nil, amount transferred is say 1 crore. And similarly, it could be 1 crore, 20 lakhs or 80 lakhs. You will have to make necessary disclosures of this particular point in your, as part of 8A of amount unspent, of what is the total amount transferred to unspent CSR account, and what is the date of transfer. If this happens before the board meeting, you'll have to give this. Even disclosures you will have to give of CSR amount spent against ongoing project, including amount transferred to unspent account for the project, what as is required under 135(6). Next important thing which has come into this year is if any application is made or any proceeding pending under the Insolvency and Bankruptcy Code, and if there is a difference between the amount of valuation done at the time of settlement, these disclosures will have to be done. As you are aware, separation of the whole position of chairman and MD and CEO is now made non-mandatory. It is omitted from the mandatory provisions, and those disclosures would also be required to be made in the board's report. Risk Management Committee, brief description of the terms of composition, names, meeting, and attendance during the year will have to come out. And of course, the new SBB-related disclosures, which are there in the slide, and there are certain additional disclosures like period of lock-in, terms and conditions of buyback, etc. will have to be done. Same is the case with Schedule 5, loans and advances by company and its subsidiaries, disclosure by listed entity and its subsidiaries. You will have to give loans and advances in the nature of loans to companies in which directors are interested. Approval of related party transaction, we've already covered this in detail earlier. I will not want to cover this. Appointment of a person, including as managing director, if it has been rejected by the shareholders, then appointment of the at the next general meeting or within a period of say 3 months from the date of appointment, whichever is earlier, will require approval. And if it was earlier rejected by the shareholders, it can be done only with the prior approval of the shareholders. It cannot be done by the board. The explanatory statement annexed to the notice should also contain detailed explanation and justification for this. I wanted to cover dividend, but if we are short of time, we are already, I think, Shabnam, it is 4:53. I would like to stop because we will have to take questions.
Yes, Narayan, since he has already covered it, though we would love to hear from you.
No.
Perhaps in the interest of time, we will take up questions.
Thank you.
Thank you so much. It was, you batted for 1 hour exactly. And it was such a humongous body of knowledge and experience that you shared with all of us. There were some technical glitches. I think I apologize because I was getting messages that there was buffering and we could not see, but the IT team, I guess, has rectified that. But must tell you, you made an opening remark about the significance of secretarial standards and guidance note. And you said earlier, people had to go and attend seminars, only then know what's the best practices. But this is now everything become a compendium, and ICSI has done a doorstep delivery. But today with these webinars, I think we are also doing desktop, desk deliveries, if I can call. So wherever we are, especially from the knowledge and practices that people like you and Pramod have brought in here, it's amazing. And I
hope we were able to hear the presentation here, or the audio was weak at times.
No, not at all. I could hear because we have all logged in as panelists, but I'm not sure about others. Once in a while, I got a message that there was buffering, but that's fine. I think
you were able to hear it?
Yes, I can hear you.
Thank you.
Yeah, because you focused, the main piece obviously was RPTs, and I know how passionate you are, Narayan, about that. Thank you very much. There are a lot of questions which started coming in even before you started speaking. I'll pick up from the chat here. I'll start with Pramod. I think some very basic question. Pramod, can dividend be declared in an
EGM? I think so. In my opinion, I think final dividend can be declared in the AGM. it would be not an ordinary business. It would be a special business, and it would require additional compliances such as giving an explanatory statement why it is taken up at the EGM. I would love to hear from Narayan.
Narayan.
No, it will have to be done because it's a ordinary business, as you're aware. Whether it is accounts, dividend, directors retiring by rotation, or all.
No, Narayan, sorry, it is EGM, Extraordinary General Meeting.
That's what I'm saying. The question is, it has to be done at the AGM.
Okay.
The dividend. Interim dividend, of course, is the prerogative of the board, but the final dividend is always the prerogative of an AGM.
Right. Okay. The next question is to Narayan. Can board's report be signed on a different date than the date of authentication of financial statements?
So, if you see, we have, in fact, done a great amount of detailing. If you see, even in the, the guidance note, okay, and whether it is board reports can it be approved through VC, can the board's report be approved by circular resolution, or who shall sign the board's report, okay, and there even the sequencing of each of this has been very clearly. For example, board report should always be dated on or after the audit reports and never on the preceding date, correct? And if financial reports, financial statements are approved by the board and signed on behalf of the board, they are required to be submitted to the auditors for the report. Only thereafter, financial statement will be signed by auditor and the audit report thereon will be submitted, correct? And as you are aware, board's report will include explanation or comments on every qualification, reservation, or adverse remark or disclaimer which is made in the auditor's report, and hence it cannot come before. So SS-4 has provided very nicely, it has been clarified as to how financial statement approved by the board and signed on behalf of the board are first required to be submitted to the auditor for the report. Thereafter, the financial statement will be signed by the audit. The audit report thereon will be submitted to the board. And in case the auditor's report is available on the date on which financial statement is approved by the board, the report should bear the same day as that of the auditor's report. However, as you're aware, even during COVID times, we found that many a times auditors were not present. In such case, the auditor's report is dated after the date of approval of the financial statement, in which case the board report should also bear a later date when the report is approved by the board. The board report should always be dated on or after the auditor's report, and I don't think it should ever be on a preceding date.
Right. Very, very logical.
Even the guidance note gives clarity on how are the annexures required to be, signed. Okay.
Yeah. Thank you, Narayan. The next question: is there any restriction on declaring dividend at a board meeting if it is held through VC video conferencing?
I don't think so. In my opinion, it's okay to declare dividend through VC as well. Since even accounts can be adopted as on date through video conference.
Yes. The mode of conducting the meeting, there is no restriction.
Yes, as on date, there is no restriction.
Yes. Narayan, there are many questions on dividend. Is it okay if I pose some of them to you?
Yeah, go ahead, please.
Yeah. This is for an unlisted company. Is it mandatory to adopt financial statements for a quarter and thereafter declare interim dividend?
If you do not do as Pramod had already covered as part of his presentation, as part of 123, he said, is that if you do not know whether there is a profit or loss in that quarter and dividend once declared, in fact, has to be paid, it becomes a debt, it is all the more important for them to assess the situation, approve it, and then do it, even if it is an unlisted entity.
Right. Pramod, for you, what documents are required by the company? Actually, what documents should the company ask for payment of dividend if it is to legal heirs of a deceased member?
So, according to me, if at all there is a claim from a legal heir, the shares have to be first transmitted in accordance with law, and then the dividend would be processed thereafter. So, to me, whatever is required, for example, if succession certificate is required for transmission, then it will follow the same process, and company should not distinguish in the process to be followed for entertaining the claims of legal heirs.
Okay. There is a question on what will happen if dividend is paid from normal current account of the bank and there is no unpaid amount for an unquoted company. That's for an unlisted company.
Yeah,
it's a very obvious answer. It will, according to me, not in compliance with Section 123(4). It is better to open a separate account as a dividend account and pay the dividend. Although there is no amount which is left after the payment is made, you can continue to carry that account for a number of years as a current account, but it should be a separate bank account with the nomenclature dividend account. That's
correct.
My understanding.
I think this is for no. You mentioned that maybe you can carry it forward if there is nothing, but most of the private companies, the bankers themselves are insisting and they title it that this is an unpaid, dividend account for this year. And they are processing it that way. So what you said is right. Let me see, Narayan, if there is anything on how to fix record date in case of private limited companies. Narayan, I don't know whether this is relevant for
not. I think dates. Only what you should do is those which are routine, probably administrative, you could skip those, and those which are more fundamental. If I know we are putting a lot of onus on you to do the screening.
No. Yes.
That will really happen.
Yes. Many companies at the AGM ratify also the interim dividend declared by the board, either along with the final dividend or where there is no final dividend, they ratify the interim dividend. SS-3 in the guidance note says not required. Do you have any different views, Narayan, on this, or do you agree?
So what I wanted to make a mention is this is a matter which I can say quite having what I can say multiple schools of thought. So if you say the key question is, does interim dividend require approval of shareholders? Correct. Interim dividend, if you see under 123(3), is declared by the board during a financial year out of surplus in P&L account and out of profits of the financial year in which such interim is sought to be declared. When final dividend is recommended by the board and declared by the members, approval of members is not required for declaration of interim dividend, because one of the view which at least even Institute has taken as part of the guidance note is that once an interim dividend is declared by the board, its noting, approval, confirmation or ratification in a general meeting is not required. However, the report should mention the amount of interim dividend declared and paid by the company during the financial year. And there are two interpretation issues which comes, and I know my own colleague Kalidas has a very strong view which comes from the second school of thought. And because some companies are of the view that declaration of dividend is exclusive domain of members in general meeting. Board recommends dividend and members declare the same. Therefore, even in case of an interim dividend, the members at subsequent general meeting must declare. And you will have professionals who have a very strong view on it. On the other hand, approval of dividend, if you say it's a privilege of the general meeting and the board can pay interim dividend if so authorized by the articles of association. So in a manner, you have already that authority built in. And whether it is subject to regularization of the interim dividend in general meeting is the key question. And the view at least taken by earlier, whatever you call Secretarial Standard Board, and which we had doled out even as part of the guidance note, is that 123(3) uses the word declared in case of interim dividend. And it is not using the word recommended. Hence, in case of interim dividend, the SSB had come to a conclusion that no approval of members is required to be sought. and interim dividend is actually paid within 30 days of its declaration by the board, and in majority of the case would be already paid before the dividend is, before the matter happens, correct? So if view 1 is taken, that interim dividend needs to be approved by the members, and for some reason it is not approved by the members at dividend at general meeting, how do you do it? How can you unscramble the end? It will be difficult, correct? Because dividend once declared becomes a debt and it cannot be revoked. I think Pramod very nicely captured it as part of his presentation. Yes. So the right of members to claim dividend arises only after the dividend is declared either by the company in an AGM or in case of interim dividend by the directors in a board meeting, I feel.
Thank you. Pramod, there's a question for you. Can bonus shares be treated as dividend?
No, it is clearly specified under Companies Act as well as under Secretariat Standard for dividends that it should not be capitalization of reserves does not really require outgo of any of the assets of the company, and therefore it should be completely separated from the concept of dividend, and it shall not be treated as a dividend.
But here, just if I can add one point, Shada, with your permission.
Sure.
As you're aware, both Section 63 as well as ICDR, and it's just supplementing. I do not have a different view from what Pramod is mentioning. What does Section 63 and ICDR say? Declaration of bonus shares in lieu of dividend is not permitted. Here, there are multiple interpretations taken by the corporates. What do you mean by the term bonus shares in lieu of dividend is not permitted? So, their first one view is that absolute quantum of dividend declared in a previous year is to be maintained. Suppose you have rupees 100 crores was dividend outgo in, say, last year, 2021. And minimum 100 crore will have to be maintained even post-bonus. Otherwise, you will fall in respect of bonus being declared in lieu of dividend. The second view is that the rate per share is to be maintained at any cost. Example, for FY21, if the rate of dividend declared is, say, rupees 10 per share, if the company declares a 1:1 bonus, then if the same rate of dividend is to be maintained on the enhanced capital, then the minimum dividend, say, for 21-22 would at least need to be 20 per share, correct? And the third, which is quite a liberal view, is the company cannot post the dividend, merely skip dividend. You cannot skip dividend. There is no provision against reducing the amount of dividend as against the previous year. But all three views are prevalent, I've seen in companies. But I think if you should be able to maintain in terms of rate per dividend, so that tomorrow you're not questioned, have you declared bonus in lieu of dividend? I thought this was three nuances which we are finding, and we find this different interpretations being taken, and I thought it will be helpful to the members.
Thank you. Thank you. Pramod, there is a question with relation to dividend again. The company which declares dividend is a wholly owned subsidiary of a foreign entity. Invariably, on the same date of the AGM or the next day, the money declared a dividend is transferred to them. Is it under the situation opening a bank account and transferring the amount declared and paying out of it and then closing it is required? I think that is not the intent of law. Your views, you have already stated what is the law and what is the practice, but maybe you can re-clarify this. Is this practice right?
Yeah, so it is again opening a bank account, whether you already hold a bank account which is used for the payment of dividend or opening a separate bank account. What is important is you keep the bank account separate from your normal current account or normal business operations of the company. In case entire dividend is paid out of it, it can be closed as well. If there is no amount, there is no point of keeping the bank account, but necessary certifications by either a company secretary or the bank that the entire amount has already been paid, all the taxes have been, tax obligations has been discharged against it, should be taken before closing the bank account.
Okay. The next two questions are to Narayan. One is on dividend, the other one is on board's report. Narayan, A Limited wants to pay dividend out of building fund. This fund was created long back and now not required. Can the company use this fund to pay dividend?
Not very clear. What does this?
I know whether it's to be transferred to any reserve or maybe.
Yeah, that's the point. Yeah.
It's not very clear. Perhaps he should. Okay, there is one question specifically for Narayan sir.
Yeah.
The company receives Nclt order for merger of companies after approval of financial statement in board meeting, but before dispatching notice of AGM or annual report. Does the company still need to restate its financial statements as per accounting standard?
So, as you're aware, in case of merger, it's very clear. If you have already approved your accounts, correct? And the accounts have been approved, everything is done. And thereafter, if the NCLT order comes, I don't think there is anything. You can give effect to that in the next year. Because once the accounts have been approved and thereafter, if the NCLT order comes, there is no need of you to restating the accounts immediately. Even if the notice is in the process of being issued to the shareholders, there's no issue. You can always give effect to it in the next year. Of course, there are requirements in the accounting standards specifically for the auditors to say is that how close it is. Was the company already knowing, or if you are already aware of, say, the hearing going to take place before NCLT, could you have timed it better? Could you have done the board meeting approval post that? A number of questions are raised and a huge amount of planning is required. Because even post the order today, which we find sometimes NCLT after pronouncing the order, it takes quite an amount of time before the company is actually in receipt of even the order, the actual written order. There is a huge gap. So a lot of circumstances, a lot of other things will have to be taken. But a short answer is, if the accounts have already been approved, auditors have cleared it, your board's report have been approved, you have already approved, and thereafter the NCLT order, you can always do it in the next year.
Okay. I received two questions much before the event started. So there is one on dividend again for Pramod. Is it not mandatory to disclose the total dividend outlay of the company? The member says the guidance note does not address this. Any views on this from either of you or both of you?
No, it should contain, according to me, while even if there is no specific, because when you are talking about, when the guidance note is requiring you in terms of disclosing, we are talking about percentage, rupee per share, correct? As well as what is the total outlay which the company is going. Earlier, which it was net of dividend tax, and now, of course, it is subject to TDS. So the answer is perfectly yes. You should disclose the outlay in the board report.
Yeah. There's one question for you. This is relating to risk management policy. The question is how to disclose when a company does not have a risk management policy. This is a statement which they have to give in the board's report. Again, it says the guidance note doesn't contain any specific guidance on this. So I think it would be useful mostly for unlisted private limited companies. Large companies, I know you have these policies, but smaller companies, any guidance?
So I would like to rather ask you, because what we are probably confusing, and Sharda, you could also chip in because you also handle a lot of these companies. What we are probably missing is, we are saying that probably because there is no policy, there is no manner of dealing with risks. I don't think it's the right way of putting it at all. It doesn't make, even if you do not have a probable policy. In fact, I still recollect in one of the meetings when I was there, and probably the risk officer was showing risk after risk after risk after risk. It went into probably 10, 15, 20 slides. And thereafter, I found this MD of this particular company saying that, boss, I want you to just add a periphery risk at the end of this, is to saying not taking risk is the biggest risk to the company. So what you will have to say is, merely because you not have a documented policy, does it mean that you will not have systems and processes? according to me, privately owned companies, entrepreneurs have got a much more robust way of handling risk than which is there in the formal way is what but I would love to hear your experience also in this regard. Sure.
No, I agree with you, because mostly they don't have policies. So sometimes they just state that, no, it's wrong to state that there is no risk, or they don't foresee any risk. Risk is always there, but how are they going to manage that, mitigate that, and what are the process and systems? Some statement under the responsibility, which is the responsibility of the board, has to be stated there. Yeah, there are, can we take for another about 5 minutes?
Yeah. Depending on the secretariat, I think so long as Rakesh Kumar has gives a green signal, we have no issues. Please, we can go ahead.
Okay. For Pramod, will SS-3 apply in case of distribution of any amount of profits by the company under liquidation?
No, it is any distribution of any amount or profits by the liquidator during winding up or liquidation will not be construed as dividend according to.
Yeah, I think it was there in your
slide. Specified also in the secretary standard.
Yeah.
Correct. Okay, Narayan, should board's report be based on group financial statements or just the standalone company results?
No, the board's report should be based on the company's standalone financial statements, as you're aware, and not on the consolidated financial statements, because it should relate to the financial year for which such financial statement is prepared. Of course, we also say that avoid repetition. If information is mentioned elsewhere, do it. And as regard consolidated financial statements are concerned, there is a separate requirement to give details of the consolidated financial statement, how your subsidiaries have contributed to the main company, which are the key subsidiaries. Those disclosures will definitely be separate. But to answer to the point, it will be only on the company's standalone financial statement.
Okay. I think there are two questions. Maybe it can be shared between you, Narayan, and Pramod. One is, when default in repayment of deposits, etc., is disclosed in the board's report, it is necessary to provide details of the order passed by the regulators for extension of time in repayment or penalty imposed. So the question is, should it be disclosed if there is an order by the regulator relating to default in repayment of deposits?
So answer is yes, definitely. I think it should be disclosed.
Okay. Now, Pramod, is this also to be disclosed? Is any impact of the extension of time which is given by the tribunal or the court for repayment in the above cases? Do you think that should also be disclosed?
Is this with regard to dividend, or is it generally in the board's report?
Generally, it's on the board's report. Do you have any view on this?
No, according to me, it's always good governance to ensure that all the disclosures which have which in any way clarifies better the financial statements or the financial position of the company to the investors should be part of the board's report.
Yeah, I think this one also was in the context of if the standard prohibits declaring dividend, even during the extension, even if an extension is given by the regulator, by the tribunal or the court, is there a prohibition? That actually was the question.
Yes, indeed, it is also specified in the secretarial standard that in case there is any extension given by any tribunal, that during that period also it should be considered before declaring any dividend. It should. Yes.
Okay. Narayan, can shareholders at AGM pass a resolution that obliges board of directors to declare interim dividend every year?
No, it can never be, because it's a prerogative of the board. In fact, as you're aware, till the time the board does not recommend, the shareholders on their whole do not get any prerogative in this regard, even for the final.
Yeah, there is a question why SS-3 requires that the dividend be disclosed on per share basis.
So I thought this was a requirement for the listed entity, Shraddha, as you're aware. And SS-3, when we were doing, we felt that it would be good that we extend the same logic even to unlisted companies, because the whole purpose of this per share was when you have face value less than 5. You have a lot of companies who have 2, 5, 1 rupee also face value. The dividend becomes in percentage becomes to a great extent, it becomes not fully disclosing what is it. So hence the per share is also required. And hence we said that what applies to a listed, it would also be good for the unlisted entities also to follow the same way.
Okay. I have received on my WhatsApp. If you are okay with it, Narayan, I'll just...
Please go ahead. Please go ahead.
Yeah, this is relating to signing of the board's report, where the addendum to the board of directors report is signed on, for example, on 29th August, say today, and the original board report is dated on 22nd, a week ago. Okay. Which date do we take as date of approval? We had a board meeting on both the dates because first was the original, then on the addendum. This question is also significant from giving information in the E-form AOC4. This is a practical question, I guess. From
so I didn't get the question quite clearly.
Original report was, board's report was signed on 22nd August.
Okay.
Then he says there was an addendum to this which had to be again approved and signed. This happened on 29th. Okay, there's a 1 week gap. That means on 2 dates, this board's report, the complete board's report is getting signed. So which date do we take as approval? Because it's relevant when we have to disclose in the AOC4.
So, as I said, that there cannot be a case of addendum being in a different date. Both should be aligned and you should have one board report because annexures to the board has to be signed in a similar manner, as you're aware, under 134(6), as you sign the board report itself. For example, I think only in respect of CSR activities, which is required to be signed additionally by CEO, or I think MD, CFO, and the chairman of the CSR committee. That's an additional for the CSR. Otherwise, annexures to the board report are required to be signed in similar manner as the board. And if you take a clue from that, both should be aligned completely.
So I do not know what is the constraint they have in this case. Maybe we will get the specifics of the case, why they had to do it twice. Perhaps I'll find out and pass on that. I think that's it. The rest of them are already covered by both of them. So any closing remarks from both of you?
So Shada, I made in terms of even for the related party I thought it will be timely for us now that we have completed the core group expert group has completed the Charter of Audit Committee, and both Sudhakar and you, supported by you have started the related party. I think it would really be in time for us to give a very good document which will cover many of the nuances. And in fact, as you're aware, Mr. Narasimhan has been requesting us to probably get all the issues pertaining to the industries, even with relating to related party. The dichotomy between 23.2 and 23.4, a dichotomy between the mains provisions and 23.9, where there is no threshold given in disclosure-related documents. Clarification which would come that even payment, besides payment, even receipt of dividend, etc., could be exempt so long as it is applicable to all. Some bright line tests on purpose and effect, which is going to come in a huge way and hit. And for these are the things which would really be timely. And I should commend the efforts being taken by Sudhakar, you, and all the other members in this direction. And I'm sure once this document also goes through the rigor, the way we have of our expert group, it will definitely turn out to be a huge, for what I can say, input both for industry and for the regulator.
I completely agree. I know, including the audit committee charter, it's. I think you started it in 2020, if I remember right. I think it has now come to a culmination. The efforts have just started on RPT, though the larger group has already given its comments. And through this forum, I would request the members at large also, we are looking at crowdsourcing it, limited to just a group here or a subgroup with 10 or 12 people. But if they can post in their queries, illustrations, best practices, whatever they have, then this can be a very comprehensive document that can come about.
Absolutely.
Pramod, any comments from your side before I close?
No, I first of all echo the sentiment of what Narayanji said. We are looking forward for many more such contributions from not just expert group or committees, but also participation from all the participants. And I take this opportunity to thank all the participants, also the ICSI Secretariat for the excellent, work done in terms of organizing these Secretary Standard weeks and picking up the relevant topics. Thank you so much.
Yes, I completely concur with you. There's a huge support and coordination which we have received from the Secretariat, Mr. Saurabh Jain, and especially Rakesh. Because at any point in time, yes, over the weekend, he has been giving us, we don't have to ask what is required to be done or what is the document is all.
It will come ready-made, virtually.
Ready-made. Yeah, he completely anticipates everything. I thoroughly enjoyed listening to both of you. Narayan, I think you require complete 2 hours or more for board's report alone because there are so many segments on it. And Pramod for very clinically assessing and evaluating, sharing with us all the best practices that you may be doing. Both the topics were very, very well handled. We had a score of about 13,000 plus people who were listening to this webinar. I just want to leave all of you with another quote. I don't know from where I have sourced it. Knowledge is discovered collectively. Knowledge is discovered collectively. Wisdom is rediscovered individually. Knowledge is discovered collectively. Wisdom is rediscovered individually. I think it is now time for all of us to rediscover this knowledge which we got from all of you individually, reflect on it. And if there are more questions, more thoughts, members and students are requested to reach out to the Institute so that we can keep revising and sharing the best practices. With that, I close this session and I thank all the viewers, speakers, and the backbone of ICSI for this program. Also wish you a happy Ganesh Chaturthi. Many of us are celebrating Ganesh Chaturthi on 31st.
Yeah. Thank you. Thank you, Shada. You've been a great host. Thank you. And thank you, ICSI. Thank you, Rakesh, for all the support. Thank you.
Bye-bye.